Welcome to my channel. Please like, comment, and subscribe. Mortgage insurance, what is it and when it's required? What is mortgage insurance? Mortgage insurance is a type of policy that protects a mortgage lender if a borrower fails to make their payments. While mortgage insurance is designed to protect the lender, this reduced risk allows lenders to offer loans to borrowers who otherwise wouldn't qualify for a mortgage at all, let alone an affordable one. Lenders traditionally require a down payment of 20% as a condition of qualifying for a mortgage, since a borrower who invests their own money in their homes is less likely to give up on making payments and let the bank foreclose on the home if their home's value drops or their personal finances deteriorate. Both of these scenarios were seen during the 2007 housing crisis and recessions, which highlighted the importance of mortgage insurance. Note that conventional loans borrowers with lower down payments pay private mortgage insurance or PMI, while borrowers who get a loan backed by the Federal Housing Administration (FHA) pay a mortgage insurance premium or MIP. Types of mortgage insurance. There are four kinds of PMI. Borrower paid monthly. This is just what it sounds like. The borrower pays the insurance monthly. Typically, as part of their mortgage payments, this is the most common type. Borrower paid single premium will make one PMI payment upfront or roll it into a mortgage. And then split premium. The borrower pays part upfront and part monthly. And then lender paid. The borrower pays indirectly through a higher interest rate or higher mortgage origination fee. You may choose one type of PMI over another if it would help you qualify for a larger mortgage or enjoy a lower monthly payment. There is only one type of MIP and the borrower also pays the premiums. But FHA loans do not just have a monthly MIPs, and they also have an upfront mortgage insurance premium of 1.75% of the base loan amount. In this way, the insurance on an FHA loan resembles split premium PMI on a conventional loan. And then how much is mortgage insurance? Mortgage insurance is calculated as a percentage of your home loan. The lower your credit score and the smaller your down payment, the higher the lender risk and the more expensive your insurance premium will be. But as your principal balance falls, your mortgage insurance cost will go down too. For borrower paid monthly private mortgage insurance annual premiums from MGIC, one of the country's largest mortgage insurance providers, range from 0.70% to 1.86% of the loan amount, or $170 to $1,860 for every $100,000 borrowed on a fixed rate 30-year loan, that is $35 to $372 per month on a $250,000 loan. Some PMI policies called declining renewal allow your premiums to decrease each year when your equity increases enough to put you in a lower rate bucket. Other PMI policies called constant renewal are based on your original loan amount and do not change for the first 10 years. On an adjustable rate loan, your PMI payments can go as high as 2.33%, is $2,330 for every $100,000 borrowed, or $585 a month on $250,000 loan. PMI also is more expensive if you are getting a mortgage on a second home. The most likely scenario with an FHA loan is that you will put down less than 5% on a 30-year loan of less than $625,500, and your MIP rate will be 0.85% of the loan amount per year. MIP on a 30-year loan range from 0.80% to 1.5% annually, or $800 to $1,050 for every $100,000 borrowed. That is $667 to $290 per month on a $250,000 loan. The lowest rates go to borrowers with larger down payments, and the highest rates go to people borrowing more than $625,500. Your credit score is not factored in MIPs. And then how long do you have to pay for mortgage insurance? With PMI, the borrower pays monthly insurance premiums until they have at least 20% equity in their home. If they fall into foreclosure before that, the insurance company covers part of the lender's loss. With MIPs, you will pay for as long as you have the loans unless you put down more than 10%. In that case, you will pay premiums for 11 years. Private mortgage insurance versus mortgage insurance premiums. While PMIs applies to conventional mortgage with less than standard down payments, you will likely need to pay MIP if you get an FHA loans. Here's how they work. Private mortgage insurance. This is typically required for conventional mortgage borrowers who put 3% to 19.99% down. Borrowers who pay PMI are more likely to be first-time home buyers and are usually purchasing, not refinancing. They also tend to have slightly higher debt-to-income (DTI) ratio and lower credit scores than conventional borrowers who do not pay PMI, according to the Urban Institute. Mortgage insurance premiums. This is required for borrowers who get a loan backed by the FHA. The main reason to pay an MIP is that doing so might be the only way you can qualify for a home loan. The Urban Institute finds that FHA borrowers tend to have lower credit scores and more debt relative to their income than conventional borrowers who pay PMI. The percentage fluctuates from year to year, but overall, about 30% of borrowers who carry a loan with a guarantee or mortgage insurance pay MIP. Another 42% pay PMI, and the remaining 30% take advantage of the loan program offered by Department of Veteran Affairs or VA, which includes a lender guarantee but does not require PMI or MIPs. If you take out a loan backed by the U.S. Department of Agriculture (USDA), you will have to pay an upfront loan guarantee fee of 1% and an annual mortgage insurance fee of 0.35% of the loan amount paid monthly. And then how to get rid of mortgage insurance. The process for getting rid of mortgage insurance depends on which type you have. For conventional mortgage with borrowers paid monthly premiums, you can get rid of PMI after you accumulate 20% equity by paying down your mortgage. You can also get rid of PMI if your home's values goes up enough to give you 25% equity and you have paid PMI for at least 2 years. Your home's value goes up enough to give you 20% equity and you have already paid premiums for 5 years. You put extra payments toward your loan principal to reach 20% equity faster than you would have through regular monthly payments. You will need to ask your lender in writing to waive PMIs if one of these things happens. For cancellation based on an increase in home value, the lender may require an appraisal. You also need to be current in your payments and have a good payments history for lender to grant cancellation at this point. I think that's all guys, information that I can share to you. Thank you so much guys for watching. If you need information related to maritime topics, you are in the right channel. And about insurance too, you can find it in this channel. Thank you so much for watching. Don't forget to give like, comment, and subscribe. Bye bye. See you in another video, guys.